Good morning, capitalists. Here is everything you should know today. Hello, capitalists. Here is everything you should know today. Markets rally as Trump pauses Iran power plant strikes. Oil plunges 13% on Trump's Iran strike hold. Gold pairs losses as Trump pauses Iran strikes. Gold miners squeezed by plunging prices and soaring energy. GLP-1 drugs reshape restaurant menus. Here is today's Markets Plus Assets, sponsored by Health Sciences Institute. The Dow Jones Industrial Average is at $46,212.08, up 1.39%. The S&P 500 is at $4,492, up 1.15%. The Nasdaq Composite is at $4,492, up 1.25%. Volatility cooled. The CBOE VIX Volatility Index printed $25.98, down 2.99%. That's a meaningful pullback from recent elevated levels, fear gauge taking a breather. Precious metals reversed hard. Gold $4,387.90 per ounce, down 4.04%. Silver $69.32 per ounce, down 0.50%. Bitcoin bucked the precious metals weakness, $70,607, up 3.35%. Picture this: markets waking up to headlines that could have sent everything vertical in the wrong direction. Instead, pause button. Trump delays strikes on Iranian power plants and energy sites. 5 days. Productive talks, he says. Iran says no talks happened. Oil craters. Stocks breathe. Gold stops bleeding. For now. Today we unpack the whipsaw. Geopolitical de-escalation theater meets real commodity carnage and a quiet consumer shift that's already rewriting restaurant menus. Thesis up front. Relief is relief, but the underlying math hasn't changed. Let's get into it. President Trump postponed planned U.S. strikes on Iran's power plants and energy infrastructure for 5 days, citing productive discussions aimed at ending Middle East hostilities. Iran's senior officials immediately denied any negotiations are taking place or will take place, calling it psychological warfare designed to block recovery in the Strait of Hormuz and broader energy markets. Before the announcement, Trump had issued a 48-hour ultimatum: reopen the strait or face strikes. An Iranian speaker warned that any attack could irreversibly destroy critical energy facilities across the Persian Gulf, where more than 40 Middle East assets have already been severely damaged in the conflict. Markets reacted instantly. Stocks rallied, the dollar weakened, oil prices collapsed, and precious metals paired earlier losses. Brent crude dropped over 13% to $96.91. WTI fell to $85.66, both coming off recent highs above $112. Gold, after sharp declines, paired losses as spot prices, and silver rebounded on the eased Middle East tension. Gold miners, however, stayed under pressure. Prices still closed down 1.3% at $4,432.09 an ounce. That's the headline snapshot. Relief rally on pause, but only a pause. Start with oil, because everything else orbits it right now. The Strait of Hormuz normally carries 20% of global oil supplies. Right now, flows are at just 5% of normal. War disruptions and threats have choked the choke point. That scarcity drove prices to those $112+ levels before the announcement. Trump's hold on strikes gave the market breathing room. Oil plunged, but the fundamentals haven't vanished. The IEA's response was already in motion. Member nations agreed on March 11th to release a record 400 million barrels from strategic reserves to blunt the supply shock. The IEA chief didn't mince words. This situation is far worse than the 1970s oil shocks combined with the Russia-Ukraine gas disruption. More releases remain on the table if the strait stays closed. Goldman Sachs upgraded forecasts accordingly. If Hormuz flows remain low, Brent averages $110 in March and April. If 5% flows persist for 10 weeks, prices could blow past the 2008 record highs near $147. So the plunge is real, but it's priced on hope, not resolution. Now gold. Monday's session showed gold behaving like the risk asset it becomes in broad risk-off episodes, extreme pro-cyclical moves, despite 6 months of heavy momentum and retail buying. When tensions eased, spot prices rebounded, and silver followed. But the safe haven narrative cracked earlier. Investors sold liquid positions amid the conflict. Surging energy prices lifted Fed rate hike odds and strengthened the dollar. Classic non-yielding bullion pressure. Historical precedent is clear. In 2008, 2020, and 2022, initial shocks triggered dollar demand and gold drops, followed by sustained rallies once macro adjustments kicked in. We've seen the drop. The rebound is tentative. Gold miners are feeling both blades of the scissors. The VanEck Gold Miners ETF, GDX, ran nearly 200% in 2025, then gave it all back and more. Year-to-date, down 27%, even after a 4.12% intraday bounce to 83.42. Lower gold revenues crush top-line income. War-driven energy price surge, oil and gas, lifts production costs. Dual margin compression, reminiscent of 2006 to 07. Investor profit-taking accelerated the move. Last year's rally gave smaller miners a nice base to realize gains, especially as uncertainty and geopolitical risk prompted asset allocation shifts. Bottom line, miners don't resume a bullish path without better risk sentiment and restored global growth confidence. They're structurally exposed to economic shocks. One pocket of the consumer economy is moving in slow motion while markets whipsaw. Weight loss drugs like Ozempic are driving Americans to consume 21% fewer calories and dine out less. Surveys show GLP-1 users spend nearly a third less on groceries, 60% dine out less frequently. Restaurant visits drop as much as 45%. Snacking and alcohol take the biggest hit, 70% snack less, 45% drink less, shifting dollars to yogurt, nuts, fruit instead of chips. Breakfast and dinner traffic suffer most. Restaurants are adapting, adding protein and fiber-rich options, shrinking portions to keep GLP-1 users coming back. We're seeing product innovation, protein-packed Doritos, cold foam, grab-and-go cups, fiber-rich popcorn, lighter entrees, mini-meals. Scale is staggering. 1 in 8 U.S. adults is on GLP-1s today. Projections point to over 30 million by 2030. Potentially putting $30 to $55 billion in annual food sales at risk. That's not noise. That's structural demand destruction when meeting menu engineering. So where does this leave the listener with capital at risk? The relief rally is real. Stocks up, dollar down, oil and gold finding a floor, for now. But the Strait is still at 5%, reserves are being drawn, and Iran is still denying talks while warning of irreversible damage. Oil at $96 to $97 is calmer, but Goldman's $110 to $147 path is still live if flows don't recover. Gold's rebound is fragile. It behaves like risk when risk is on. Miners remain squeezed on both sides. Revenue down, costs up. Recovery tied to sentiment, not just price. Meanwhile, the GLP-1 wave rolls on quietly. Calorie destruction, traffic shifts, menu reinvention. Food companies and restaurants that pivot to protein fiber focus may hold share. Those that don't face real revenue pressure. Markets love de-escalation headlines. They hate prolonged uncertainty. We're in the first camp today. Relief is cheap to buy. But the second camp is never far away. That's the play. Your move. That's the roundup for today. You now know more than most people do about what is going on in the world of finance today. Thank you for listening to The Capitalist and supporting us. Together we will make capitalism great again.